Hello, welcome everyone. This is Bob Grody, and I'm the chairman of MISA, the Meat Industry Suppliers Alliance, the sponsor of today's presentation. On behalf of the MISA Council and the Food Processor Suppliers Association, I'd like to welcome you to today's webinar. Please note that today's presentation is being recorded and all participant lines will be muted broadcast. The presentation will last approximately 45 minutes. It will include a question and answer period after the event. However, at any time, you can queue up a question for us during today's presentation. To ask that question, type it in the Q&A box in the lower right-hand corner of your screen and click the Send button. Today's webinar topic is titled The Affordable Care Act. Our speaker is Mina Amir-Mokri, who is a partner in Barnes & Thornburg's LLP's Chicago office and is a member of the Corporate Employment and Finance, Insolvency, and Restructuring departments. She routinely counsels clients on employee benefit plans, including matters arising under the Internal Revenue Code. Now, without further ado, I'll turn it over to our speaker, Mina Amir-Mokri.
Thank you, Bob. Good afternoon, everyone. It is a pleasure to be here to speak about a topic that I understand is of interest. We're going to cover a lot of bases this afternoon, and what I sort of loosely have referred to in the subject as the employer checklist. We'll cover the employer mandate, which is the shared responsibility and penalties provisions. That's what you may have read about in the pay or play provisions, mandate, the requirements for benefit plans under the Affordable Care Act. Some of the tax provisions, the Cadillac tax, which is again upcoming. We don't have much guidance on it, but it's a thing that has been commonly talked about. Other employer fees and taxes, reporting requirements, and also address provisions of interest to small employers. A quick note, most of these rules don't apply to small employers, so certainly the shared responsibility employer mandate does not apply to employers with employees in 2015 and fewer than 50 in 2016 and beyond. But there are some other rules that apply to small employers, and they largely revolve around relief for small employers and assistance in providing health benefits to their needs. Okay, let me. Apologies. So, large employers. What's the definition of large employer? This is important for purpose of the shared responsibility provisions. That is employers with at least 50 full-time employees beginning in 2016. And as I mentioned, most of these rules apply to large employers or applicable large employers, which is a commonly used term, and small employers have considerable flexibility under the ACA. The mandate. The mandate is that large employers must offer affordable, minimum value health coverage to all full-time employees and their children, or penalty. This is the pay or play provision. A large employer, at least 100 full-time employees or full-time equivalents. We'll get to the definition of full-time equivalents. At least 50 full-time employees or full-time equivalents from 2016 onward. Who is a full-time employee? A full-time employee is one who works at least 30 hours a week or 130 hours a month. Full-time equivalent is a part-time employee counted as full-time equivalent by adding their total hours for each month divided by 120. Seasonal employees do not count, but that's with the caveat that it depends on we have to be caught about that definition. And really, truly has to be a seasonal employee, and it's typically someone who works during the holiday season. There's a reasonable good faith interpretation standard in the regulations to determine who's a seasonal employee. But the seasonal employee really could not have worked more than 120 days in any calendar year. So the thing is to count them in if there's doubt. They might actually be variable for employees, and then subtract them out. So these are, again, seasonal employees can have a very loose definition, so you really have to be careful about how you define a seasonal employee. And then what is the employer? Who is the employer group? In the Internal Revenue Code that apply to the Affordable Tax for purposes of determining the employer, and all controlled group members are treated as a single employer for purpose of determining how many full-time employees or full-time equivalents are in count of the employer. And controlled group members are essentially, a company and its subsidiary, wholly owned subsidiary, would be in the same controlled group, or companies that are commonly owned by 5 or fewer individuals, a brother-sister relationship, or they're otherwise affiliated through the services they provide, and it's a pretty broad definition. What's interesting is that the ACA applies these controlled group rules for some purposes and not for others. We'll talk about that. But remember that when you count full-time employees, it's not just for purposes of the company proper. You really have to count all the affiliates as well, and then run the test to see which affiliates which affiliates need to be aggregated based on the test. Now, the rules are also not fully applied because under other definitions, for example, for purposes of other benefit plans like the 401k plan, you apply the controlled group rules for defined benefit plans, joint liability attaches. We'll get to how that doesn't apply with respect to this, with respect to the ACA, and also another note, the purposes of the ACA, for example, if you're a U.S. company and most of your employees work overseas, abroad, and don't work in the U.S., those individuals would probably not be counted for purposes of the full-time employee rule. Or let's say you're a foreign company and you have a small subsidiary in the U.S. that only employs 20 employees. So would the shared responsibility rules apply to you? No, they probably would not. So the measure is really the U.S. employees who work, or employees, even foreign employees, but employees who work in the U.S. who would be covered by the health plan. So when we say the controlled group rules apply, not all of the aspects of the controlled group rules apply, and some of them have been modified for purposes of these rules. So we'll get to some of that, but in this presentation. Employer mandate. Who offered coverage and how and for how long? Full-time and their children up to age 26, and an important aspect of the health coverage has to be affordable, and if the single premium doesn't exceed 9.5% of the safe harbor, and the safe harbor could either be measured by W-2, which is employee pay rate, or federal poverty level, and we'll get to some tests and what those mean. but what those safe harbors really mean and how to be applied. Coverage provides minimum value. It would, if the plan pays at least 60% of allowed charges for essential health benefits. And plan dates, some of them apply to all health plans, and others apply to those that are no longer grandfathered plans. So which ones apply to all health plans? These are the parameters and rules that apply to all health plans. Annual limit on essential health benefits, lifetime limit on essential health benefits. These are sure certainly insurance carriers and those who sponsor health plans are well aware of. No pre-existing condition exclusions. Coverage of children under age 26, limits on rescinding retroactively, need a limit on waiting period, so waiting period can no longer exceed 90 days. We'll get how this rule also plays with rules with respect to the measurement of full-time employee status. Limits, deductibles, and out-of-pocket maximums, and caps on health FSAs. So these are, and then it's applicable when plans lose grandfathered status. Additional claims procedures and external review requirements, full coverage of preventive care, coverage of patients participating in clinical trials, patient protections, and non-discrimination in insured plans. So responsibility, and this is the payer plate or employer mandate, basically. And Section 4988 of the Code imposes penalties on a large employer. If any of its full-time employees enroll in an exchange and receive a premium tax credit or cost reduction credit, and if the large employer fails to comply with certain requirements. So the question to ask, if the employer has at least 100 full-time equivalent employees in the last year, or at least 50 starting in 2016. So starting 2015, 100 is the measure, 2016, 50. The question to ask is, does the employer offer health coverage to all full-time employees and children? The answer is yes. The question is, does the health plan pay for at least 60% of covered health expenses for a standard population? The answer is yes to that. The next question is, do any employees is the coverage affordable? So do employees have to pay more than 9.5% of their income for self-only coverage? So if all those are yes, with respect to the last one, if they have to pay more than 9.5%, no. If threshold is affordable, so 9.5% or less, there is no penalty due. Employer offers affordable minimum value coverage for all full-time employees and their children, and their employees would not be eligible for a premium tax credit or cost-sharing subsidy, and so the shared responsibility, the penalties would not apply. So that's sort of broad overview of what needs to be those that need to be complied with for these rules for the penalties to not apply. So the penalty was supposed to be effective for plan years beginning in 2014, but of course now it's shifted to 2015 and beyond. So for employers with more than 100 full-time employees, penalties will be assessed for the 2015 plan year. To be eligible for this relief, the the employee not reduce its workforce or the hours of service of its employees between February 9th and December 31st, 2014, except for bona fide business reasons. The employer may not eliminate or materially reduce coverage from February 9th, 2014 through December 31st, 2015, and the employer can complete a certification that is entitled to this relief. Large employer. Again, means employee who employed 50 or more full-time employees on business days during the preceding calendar year. This is for 2016 onward. Full-time employee means an employee who works 30 hours, at least 30 hours a week. It may be determined on a month-to-month basis. Employees are not full-time or count as full-time equivalents. We've been through that rule. The number of time equivalent employees for each month rounded to the nearest 100 is added and then divided by 12. So seasonal employees, caution, they don't count, but they truly have to be seasonal employees. And all members of the control group are counted for purposes of counting how many full-time employees or full-time equivalent employees have. And sub, if a company has 20 employees and the sub has 30 employees, that 50 employee threshold would be met for purposes of the shared responsibility rules applying. So, 2014 only, any 6 consecutive month period in 2014 may be used to determine large employer status for 2015 or determine whether the employer is eligible for the 2015 transition. Applicable to employers with fewer than 100 employees. With 50 or more full equivalent employees who do not offer group health coverage to at least 95% of their full-time employees, and their are subject to a penalty equal to $2,000 per year per full-time employee in excess of 30 full-time employees. And for 2015, the 95% threshold is 70%, and the 30 employee threshold is 80. 80 employees. That penalty. Penalty is imposed only if at least one of the employer's employees purchases health insurance coverage through one of the state exchanges or the federal exchanges and receives a tax subsidy in order to purchase that coverage. If the employer offers group health plan coverage to at least 95%, 70% for 2015 of its full-time employees and their dependents, but fails to offer coverage that's adequate to a particular full-time employer, offers coverage considered unaffordable, the employer will be subject to $3,000, a $3,000 annual penalty for each full-time employee who purchases through an exchange and receives a tax subsidy. Adequate means the 60% of allowable costs under the plan that needs to be the offered under the plan, and the coverage is affordable if it does not exceed 90% of the employee's household income. And we mentioned there are 3 safe harbors by which you can measure that, which again we'll get to: the federal poverty line, W-2 wages, and there's hourly tests that can be used as a safe harbor. employee is considered to have been offered coverage if coverage is offered no later than the first day of the month after 3 full months of employment. And so this is the maximum waiting period requirement now is 90 days, and anything obviously beyond that violation. I think I mentioned we'll get to how that will work with the periods for the shared responsibility. Is measured with respect to, by reference to the self-only coverage, and so family coverage, spousal coverage, etc., doesn't apply. Large employers can use the following affordability safe harbors. The W-2 wages one is the total compensation, basically, that be earned. And so, for example, a measure that says 95%, 9.5% of W-2 wages toward health insurance coverage, not to exceed a certain dollar threshold per month, like $150 or something, would work that way for the higher paid employees, wouldn't pay a greater proportion than they need to of their wages. W-2 wage safe harbor tends to yield a higher role than, say, the federal poverty level, because the federal poverty level for 2014 was $11,670 for one person. Divide that by 12 and multiply that by 9.5%. That gets you a level 90. That yields $92.39, which would be charged. And that is the safe harbor used, then the affordability that would apply, that the employer would invoke, would be lower than likely the W-2 wages. Again, depends on the employer, but any of these safe harbors can be used. The rate of pay is basically for hourly employees, it would be 130 hours multiplied by the low rate per month as of the first day of the plan year. And for non-hourly employees, their monthly salary rate could be used. Again, something could be W-2 wages, and the rate would, W-2 wages safe harbor would probably best work if you have a stable workforce, because it would be administratively burdensome to calculate that for individuals. Same with the rate of pay. From an administrative standpoint, the federal poverty level safe harbor is probably the easiest to apply, but yields a lower threshold, and so it might be worth the administrative burden to use the other two safe harbors. Different affordability safe harbors can be used for different categories of employees, salaried, hourly, or folks in different geographic locations, or different subcategories. Any of bona fide business criteria could be used to distinguish on the groups that way. Those regulations provide for the first year an employer becomes a large employer, no penalties will be imposed for January through March for an employee not previously offered coverage to offer coverage no later than April 1st. So way of saying that the important thing in the important effect of this employer mandate, or player shared responsibility rule is that it's very important to identify the full-time employees and have a method by which to identify if an employee is a full-time employee or employee status of ongoing employees. And the rules are pretty complex and pretty convoluted, so to go through some of the key terms that are used to apply these rules, there's the initial measurement period, and over the rules for new employees first, and then with the ongoing employees, a lot of the same terms apply and a lot of the same rules apply, and we'll point that out. I'll point that out. But in this measurement period, and the equivalent of that for ongoing employees is standard measurement period, which we'll get to. But for new employees, the measurement period is the time period of at least 3, but not more than 12 months, measured from an employee start date. Selection uses to determine whether a new employee who's a variable hour employee or a seasonal employee is a full-time employee. So, and another term is start date, and that's the state the employee is required to be credited with an hour of service. And stability period that time period selected by the employer that follows the initial measurement period and is used to determine whether an employee is full for the look-back rule. It has to be at least 6 months, can't be shorter than the initial measurement period. So if you measurement period that's 4 months, the stability period can't be less than 4 months. Employees, it must be the same length as the stability period for ongoing employees. So there's restriction as well. The administrative period is not required. It's really there. It's optional. It's selected by the employer. It can't be more than 90 days. Between the initial measurement period and the stability period, and it allows the employer time to evaluate whether the employee averaged 30 hours per week, whether they are actually a full-time employee for purposes of the stability period. So, seasonal employee, again, we caution that, be careful with this definition. Yes, they can be excluded. They really have to truly be seasonal employees. And full-time employees, fewer than 30 hours a week. And that's another definition that, and depending on the company, you have to be very careful how you apply it. Variable hour employees really add complexity to this. So this is a variable hour employee is when, based on facts and circumstances, at start date, the employer can't determine whether they're reasonably expected to be employed on average at least 3 hours, initial measurement period, because they're variable or otherwise uncertain. And it's not categorized as part-time. They'd be deemed a full-time employee. So an employer could just cut through and say, you know what, we'll subject to this regardless, and we're not going to go through all of this to see if we're going to be subject to it or not. And we want a full-time employee or a full-time equivalent. But so The employer will be required to assume so yeah, the employer will be required to assume that although the employee's hours of service might be expected to vary, the employee will continue to be employed for the entire initial measurement period, and the employer will not be permitted to take into account the likelihood that the employee's employment will terminate before the end of the initial measurement period. So the employee hired needs to be categorized as either variable hours, seasonal, part-time, or deemed full-time employee. Not, they'll be deemed to be a full-time employee. So that, as I mentioned, is the default. In other words, if the employer reasonably expects that the newly hired employee will work more than 30 hours a week, then they should just be categorized as a full-time employee. So regulations provide some of the factors in determining whether someone is deemed full-time, whether they're hired to replace someone who's full-time, within the same or comparable positions are full-time, and whether the job was advertised as requiring 30 hours or more of service per week. The deemed full-time employee is offered health coverage under the employer's health plan by the first day of the month following 3 full calendar months of employment. And if the employee was otherwise eligible for coverage during the 3 calendar months, the employer will not be subject to health care reform penalties for that newly hired full-time employee. What a 91-day period rule. So here is this works is if the measurement period is 12 months, you really apply the 90-day waiting period. So the employee used a reasonable period of time to determine if the employee is eligible for coverage, but that can't exceed the coverage has, because the coverage has to be effective no later than 13 months after the start date. That's why you really can't, the total admin period allowed and the total initial measurement period allowed are not going to add up. If the minimum is 13 months from the start date, if they're full-time, they have to be covered. Then you can't apply the 90-day waiting period to a fullest extent. Determine who the full-time employees are. Okay, if the newly hired employee is a variable hour employee, a seasonal employee, or a part-time employee, the newly hired employee's hours of service must be measured for the initial measurement period. If the hired employee averages more than 30 hours per week during the initial measurement period, he or she will be treated as a full-time employee for the following stability period. So, of course, the sequence is initial measurement period, administrative period, which is not required. It's just for convenience of the administrator if they need it, and the stability period. And the employer can determine full-time status on a month-to-month basis with the need to apply the look-back rule. Or they apply the monthly rule or the look-back rule to different categories of employees, and transfer back and forth between these methods. Employing the look-back measurement method to determine employee status of an employee may apply the monthly measurement method to that employee beginning on the first day of the fourth full calendar month following the calendar month in which the employee experiences a change in employment status. So the employee had begun employment position or status, the employee would have reasonably been expected not to be employed on average at least 30 hours service per week. So this applies with respect to an employee to whom the employer member offered minimum value coverage by the first day of the calendar month following the employee's initial 3 full calendar months of employment through the calendar month in which the change in employment status occurs, and only if the employee actually averages less than 30 hours per week for each of the 3 full calendar months following the change in employment status. Full calendar months between the employee's change in employment status and the application of the monthly measurement method. Employee's full-time employee status is determined based on the employee status during the applicable stability period. Continue by the monthly measurement method through the end of the first full period that will apply had the employee remained under the applicable look-back measurement method. And of course, methods can be used for different groups. So it can change its initial measurement period and stability period from year to year. Once that measurement period has started, the initial measurement period and administrative period combined can't extend to the end of the 13th month, at least following the new employee start date. So the initial measurement period can't exceed 12 months, and this is if maximum is used between the administrative for a new employee who has to be covered by the 13th month. This is how the 90-day waiting period can't be imposed in full. So how to count hours of service. Hours of service include not just hours for which the employee is paid, but also hours for which the employee is entitled to payment for a period of time during which duties are performed, such as vacation, layoff, associated. Okay. But under worker compensation, unemployment compensation, or disability insurance laws for hours that would have been by employee not required to be included. Actual for the employee, the employer calculates actual hours of service, days worked, their equivalents, and different methods for calculating service for different classifications may be used. Classifications are reasonable and consistently applied. Or can't use days worked or weeks worked equivalency methods for a non-hourly employee if it would substantially understate the employee hours of service. Some guidance on how to treat commissioned salespeople, adjunct faculty. In other words, folks employees with potentially substantially variable hours. There are special rules for purposes of determining first and last payroll periods. If the payroll period does not end on the first day of the initial measurement period or end on the last day. So there are options how to do that. In service, there are two special rules addressing what happens if an employee stops working or terminates employment and then resumes work or is rehired. And the two key rules: an employee treated as a new hire only if the employee goes 3 weeks without and 26 weeks for school employees, without being an hour of service. If an employer does not have a 13-week break in service, it can be treated as a continuing employee for purpose of utilizing the rule that allows an employer to avoid penalties. So is rule of parity. Under the rule of parity, a new employee goes at least 4 weeks without hour of service would be treated as a new hire upon resumption of service, and his initial measurement period would then restart. The period of his or her absence is longer than his prior period of employment. Applies only if the employee is not treated as a new hire, and certain special unpaid leaves of absence and have to be disregarded, such as sim-law leave, military jury duty leave. So obviously you don't count those special unpaid leave absences as part of the standard measurement period, or you have to assume that the employee the same number of hours of service during the special unpaid leave as they during the standard measurement period. Breaks and service. Similar rules apply to school employees, prohibiting the employer from counting employment breaks at least 4 consecutive weeks. Employees, there are those who have been employed for at least one complete standard measurement period. Same terms apply. Measurement period, except it's not initial, standard measurement period, stability administrative period, and stability period for ongoing employees must be the same length as the stability period for new employees. Administrative period is not required for measurement. So if an employee or more hours per week during a standard measurement period, they're treated as a full-time employee for the following stability period. And here's an example of how this can apply. So if the employer chooses to have a standard measurement period that begins each November 1st and ends on the following October 31st. The employer will then have an administrative period lasting from November 1st through December 31st. The employer, and again, this is for ongoing employees. The employer could then choose a stability period that starts January 1 and December 31. And for 2015, the period would run from November 1, 2013 through the October 31st, 2014. The administrative period during which the employer would final calculation of the hours run from November 1st through December 31st, 2014. The period would then run from January 1, 2015 through the end of that calendar year. That means an employee who averaged 30 hours per week from November 1, 2013 through October 31, 2014 be treated as a full-time employee for calendar year 2015. And there's no requirement that an employer have an administrative period between a standard measurement period and a stability period. Of course, different measurement periods can be used for different employees, groups of employees. Okay. And change the standard measurement period and stability period from year to year, but can't change the current standard measurement period once it started. And same rule counting a new employee's hours apply for purposes of an ongoing employee's hours, and same break and service rules apply. And employer for full-time status beginning with the standard measurement period, the same way as full-time status for other ongoing employees. So there's an example of a calendar year standard measurement period that also uses a year initial measurement period beginning on the employee's start date, which has a new variable hour employee whose start date is February 12th. For full-time status, first based on the initial measurement period, February 2016 through February 11th, 2017, and again, based on the calendar year standard measurement period, if the employee continues employment, beginning January 1, 2017. So, transition of new employee to ongoing employee. There is some examples and illustrations there. Okay. So, of penalties to members of the control group. So all members of the control group are treated as a single employer for purposes of determining whether the members of the control group are a large employer. The actual penalties are imposed separately on each of the members. You're a member of a control group, but your employee did not purchase coverage on an exchange and receive a premium tax credit or sharing subsidy, you're going to owe the penalty, but you are, for purposes of measuring how many full-time employees and whether the rules apply, your controlled group rules are applied to determine whether it applies to your controlled group, but you won't be assessed that penalty if your employee was not the one who got the premium tax credit. But the third offset for calculating the penalty for not offering coverage is allocated among members of the control group. So, and this, the application of this rule is not has all kinds of sub-rules associated with it. Oh, and then there's some special relief that applies, and there's some transition rules as well that outline. So just to quickly go over some of the other checklist items, these are patient-centered outcomes research institute fees. They support clinical effectiveness research. They're paid annually. They're paid by insurers and plan sponsors of the self-funded plans. They're not owed by the plans themselves. Transitional reinsurance fee, again, and there is 2018 P4A fees. Transitional reinsurance fee, end date 2016, applies to health insurers and self-funded group health plans, and there are high-cost individuals and enrolled in non-grandfathered individual health policies. Of course, no coverage and inadequate fees, that's the payer-play shared responsibility fees, or penalties that would apply that we've just talked about, and the CAT tax which begins in 2018. We're still waiting guidance, but it applies to insurers or self-insured health plan sponsors, grandfathered, non-grandfathered plans, 2018 and later, and this is generation to raise revenue, basically, reduce the high-cost coverage, and it's really to encourage insurance companies, employers, and employees to control healthcare costs. There's a 3% tax on excess benefits, and applies to thresholds, above payments above a certain amount. And of course, guidance is expected soon on that. Reporting requirements. Again, these are the employee covered and employee premiums, the shared responsibility that will kick in 2015 will have their associated reporting requirements. The others I'm sure you're familiar with, they've been around for a little while. With respect to small employers, the rules, the shared responsibility rules apply. Employers with less than 50 full-time equivalent employees, and the AA provisions that do apply to small employers include the smaller tax credit and small select and pay for through special insurance marketplace. Basically, that is it. And I apologize, I'm way over the other time. But let's see if there are questions. So I apologize that we're so over the allotted time, and I'm happy to respond to questions directly, and you can email me with questions. My email address is at the end of the slide presentation, so I'm happy to answer all the questions.
All right, looks like we don't have any other questions for today.
Well, all right. Well, Mina, I appreciate your presentation and your wonderful insights. I'm sure everybody will be able to take this valuable information and apply it to their individual situations back home. Also, thank you for your offer to answer questions via your email. Please take note of that as well. This concludes today's webinar. Upon exiting the event, you'll be directed to a brief survey regarding today's session. Your input is greatly appreciated, and once completed, you'll be given a link that will take you to the slides for today's presentation. You can now exit the event by closing your browser window. And thanks again.